Hey guys, welcome back. Smash Property Market Update for July. We're back with probably one of the most comprehensive property market updates that I have put together. Spent a ton of time preparing and pulling together all of the data that we need to make this, I guess, as well-rounded as it possibly can be. So before we get into it, none of this is financial advice as usual. And also don't base any investment decisions as it relates to you buying a property on what you see in this report. This is just to give you an idea about potentially areas you might want to pay attention to, where to look, that sort of thing. Because like I'm a human. I sometimes get stuff wrong. Very rarely, but no, I'm just kidding. I get stuff wrong all the time. But just all I'm saying is just be cautious, be careful. So let's just dive straight into it. And I guess the high-level summary is the market, the property market that is, has continued to rise month on month. So we're now at 5 months of consecutive market growth across the country. National dwellings rose by 0.6%. So when we look at it annually, we're up 3.4% across Australia as a collective. So a couple of things that are driving that. Obviously, the rate cuts that are starting to sort of filter into the market. And I've seen some pretty low rates, like some investors paying like 5.8%, which is amazing. That's not me, by the way. I'm still in the high fives, low sixes. In fact, I don't think I've got anything in the fives. Maybe not. Might have to speak to my broker. So rate cuts are sort of like giving people a little bit more confidence, based on where they once were. So in my opinion, I see us entering into a new phase of credit cycle expansion. And historically, this is a good time to get into the market just before all of, I guess the masses run in and jump in, as we tend to see historically speaking. So just a quick snapshot of the economics behind the country at the moment. So the cash rate at the time of recording this, and we're at the 1st of July, is expected to hit just above 3% by December. And that's the cash rate, remember. So we've got inflation back within the RBA's range of 2 to 3%. Core inflation does remain elevated, so that is one thing to watch. Unemployment is pretty stable, sitting at 4.1%. Cash rate, as I mentioned, expected to come back down further based on where it is right now. And even into 2026, it's looking like there might be a few more tiny little rate cuts as we go through. Take that with a grain of salt, though. These things can change very quickly. And interestingly, the construction industry is still strained with costs. There's delays, insolvencies, which is all slowing down new supply in an already supply-crunched market. So these sort of things create a little bit of a window of opportunity here for investors that want to jump on it. So taking a look at the capital cities. Now, I always love this one because this is interesting to go through. Capital city performance. Darwin, month on month, leading the capital city charge. Darwin is up 1.5%. You can see quarterly it's up 4.9%, and annually up 6%. So it's had a massive little surge in probably the last maybe 3 quarters. Median value sitting at 537. Canberra, interestingly, is second on the list here. Month on month up 0.9%. Quarterly growth 1.3% up, and annually you can see it is only up 0.3%. So it was actually, I think this was in a negative annual growth position maybe last month. Might need to check that. But we sort of had a bit of a surge there from Canberra of all places. Perth up 0.8% now. Perth annually is up 7%. Quarterly growth is up 2.1%. And I've got to, again, eat my words. I keep saying Perth is a market you don't want to buy in. And I still stand by that. But, and I might get into this a little bit later in the potty, but there are some areas, particularly south of the CBD, that I still believe have some good value left in them. Got to be very, very cautious about the style of property, the price you pay, the yield that you get. But there are still some value pockets in the Perth region. Brisbane up 0.7% month on month. Is tied with Perth on an annual growth, up 7%. Median value in Brisbane sitting a little bit higher than Perth, but not too far ahead. Oh yeah, it was 100 grand more. That is a little bit, Nicholas. Sydney, Melbourne up 0.6 and 0.5% respectively. And you can still see Melbourne's down annually, 0.4%. And this is just across the median levels, right? So there are obviously areas in Melbourne that have grown. There are areas in Melbourne that have gone backwards and areas in Melbourne that have been stagnant, as with every single market that we buy. Adelaide is, up 0.5%. In my opinion, cooling from where it once was last year. But it's interesting to kind of look at that and just kind of, I like looking at this monthly, even though I encourage people to not, don't, month on month property movements are, in the grand scheme of things, little ripples in a big ocean. But it's just nice to pay attention to and see like what's bubbling away and all that sort of thing. Taking a snapshot look at the regional markets combined are up 0.5% month on month. And you've got standout states in Queensland, WA, and South Australia. And I'm going to get into a market that I think is definitely one that we are buying in and one that I would be paying attention to for the DIY investors out there. Across the regional market, stock levels remain pretty tight. So listings are down. There's not much, new dwellings being built on the market, and that just adds more pressure to an already pressurized system. And when we look at net interstate migration, people moving from Sydney to Melbourne, people moving from Sydney and Melbourne into southeast Queensland, some parts of South Australia and WA, is fueling a large part of the rise in regional markets, in key regional markets, particularly those regional markets that have the affordability, lifestyle, and jobs. So this is why I've always said that there are certain regional Queensland markets that have performed very well, and I stand by will continue to perform very well for those exact reasons that I've just mentioned there. So one of the things I looked at this month was where could prices spike next? And I'm never one to I don't like going and predicting what is going to happen, because at the end of the day, no one knows, right? It's all just happening, and we're all a part of it. So, but I was like, okay, well, when we break this down, it's really what drives price. It's just basic economics, right? Supply and demand, right? If there's a constriction in the supply and a surging demand, then we've got an imbalance, and therefore you'll see that in prices. So what I looked at was population growth and new dwellings approvals. So I'm going to put this up on the screen here so you can see New South Wales. And actually, before I get into this, the population growth data has come from the Australian Bureau of Statistics and the Centre for Population, which is an Australian government thing. They only release data up until 2024. So if anyone's telling you they've got population data from last month, it's an estimate, not what the actual people that count the population are saying. So just to be clear, which is why I've said it's from 2024. It's the nearest accurate number we've got. New South Wales population growth in 2024 grew by 137,000. All right. Dwellings per 1,000 people is sitting at 5.3. So what does that mean? That means that New South Wales is especially vulnerable to price pressure due to the fact it has a very weak response in the supply available. So if I can simplify it further, they're not building enough houses quick enough. All right. Victoria and Queensland, Victoria population grew the most out of all of the states, which was a surprise to me. That's largely fueled, I believe, by net overseas migration, not net internal migration. But dwellings per 1,000 people, Queensland and Victoria largely the same. South Australia, WA, a little bit better. So that means they are building dwellings more quickly, or whatever we kind of get the word out. So New South Wales historically has been the market that generally performs the most, and you can see that reflected in the median value in Sydney being, over $1 million. That's largely why. We've got tons of people moving here, population's growing relative to how quickly we can build houses. It's just not there. We can't build them quick enough. But Victoria, Queensland, not too far behind. So the long and short of this is, if you're buying in New South Wales, Victoria, or Queensland, over the long term, you're going to do all right. Unless you're buying in these little towns of 100, maybe even less than 1,000 people. Don't do that. Buying a reasonably sized regional centre if you're buying in those markets. All right. So hopefully that made sense. I felt like I could have maybe done a better job at that, articulating that. Anyhow, we move on. Where to focus based on your budget. So under $500,000, here are some areas, regions, locations that I think might be of value to you. So Mackay region, not just Mackay City, but the region itself. You can definitely get something in and around the 450 mark with a decent yield. In terms of its market trend, I'd say it's quite stable in the sense of growth. It's had a lot of growth. I think it's at a stable position, where stable meaning it's just going to steadily grow over time. So this will suit investors that sort of want to balance growth and have a decent cash flow along with it. So why is Mackay a market that I'm focusing on and looking at from the point of view of property investors? Now, historically, Mackay has been, I would never have classed it as a mining town per se, but it's been heavily reliant on mining. However, we've got other markets or other industries, I should say, logistics, agribusiness, with that are sort of not overtaking the mining industry in Mackay, but definitely adding to the economy, adding that diversification, which is key for making sure that the town itself or the region itself isn't sort of subject to those boom and bust cycles as we've seen in mining towns previously. So you've got very, very, very low vacancy rates in Mackay. And like I said, that diverse economy base, which is sort of bucking the trend of what it once was many years ago now. Bundaberg, another region that I really like. We've been buying in Bundaberg for a while. It continues to be a good market under 600,000. And if you can get it under 500,000, but those days are pretty far gone. There are some stuff you probably see online. Got to be very picky about it. So I would always say, if you're going to buy in Bundaberg, buy on a large block of land and buy it as lower price as you can get, or because you're going to get a good yield and you've still got that upside for growth as well. So Bundaberg, the trend has accelerated a lot. Like, we've been buying there for a while, and we've seen month on month the market sort of get to a point where I'm like, hey, we need to be cautious about what we're doing here. And again, Bundaberg I like because obviously, I mentioned many times before, the health sector in Bundaberg has been massive, but you've got a bit of agritourism in the area as well, and an extremely constrained housing supply, which makes it, based on its economy, population movement, it makes it a lot more resilient than those mining heavy towns like Mackay. So love Bundaberg. Now, Rockhampton. Rockhampton has been a market, again, we've been buying in for a while. We were buying there when properties, houses started with 200-something thousand. I still believe that there is good buying under 500,000 in Rockhampton. That way, then we get the good balance of yield and growth. Again, similar to Bundaberg in the sense that it has a diverse economy. It's not dependent on one thing. Agriculture was a big thing there, still is, but education is also new and emerging there. Hospital precincts, and the broader investor sentiment has picked up a lot in the last, which is actually surprising, to be honest, in the last, I'd say, couple of months. Like, just speaking with our people on the ground there, it's popping off. And I thought Rocky was done, to be honest. It's still going. Again, want to be cautious in and around the 500k mark. We don't want to be going too far north of that. There's some other markets I'll tell you in a second that are good. Wagga Wagga, New South Wales. It's, in my opinion, at the early stages of growth. We can still get a good balance of growth and yield there. I love Wagga Wagga. I was there early this year, actually. Big defence presence, big education presence, lots of little health anchors in the region and the town. In my opinion, quite low volatility with consistent demand. So it's essentially an inland city, is Wagga Wagga. Nice place to go if you ever want to go down there as well. And also a decent place to invest for under 500,000. And another one on the list, the final one here is Grafton. Grafton, I was hesitant. I was like, I've got to sense check this. This doesn't make sense. But it's a little quiet achiever. We've got strong rental returns there, stable population that is growing, and is great for the yield-focused investors. So I wouldn't be saying that there's a ton of growth in Grafton, but I am saying that there's pretty decent yields there for the price point that you are looking at. So that's where to focus for under 500,000. Now let's move into the $600,000 range. Where to focus, where to buy. Starting with Ballarat and Bendigo. Now these have been good markets for a while. So I would be wanting to get in there between the sort of $500,000 and $600,000 range. I believe the market is pretty stable. I'm not saying that it's going to, rapidly expand and grow. So it's stable. It's good for those balanced investors again that want a decent, consistent growth over time, but also want the yield to accommodate that as well. The reason why Ballarat, I think, is a reasonable consideration is it's just got that good, strong commuter corridor from Melbourne. Good education hub, decent lifestyle as well, that part of Victoria. In fact, Victoria as a whole is quite nice. I used to live in Benalla many moons ago. Bendigo, similar, I guess, numbers as Ballarat. It is a key regional capital, big government presence, good transport links, and I think a growing appeal for investors. So Ballarat, Bendigo, ones to watch in Victoria. Albury-Wodonga, so the Twin City on the border, Albury, New South Wales, Wodonga in Victoria. And again, in between that sort of 5 to 600K range, I think we're going to have modest growth in that market with a balance of good growth, good yield. I think it again, probably similar to Ballarat and Bendigo, not markets that I'm saying that, oh wow, these markets are going to be 700,000-800,000 anytime soon. That's not the case. It's just steady growth over time, lower risk, good yields, which allow people to have a stable portfolio. This is probably more so for the buy and hold investor, or potentially the reno and flip investor as well, if you can buy some properties there that need a bit of love. And then Salisbury/Elizabeth, northern side of Adelaide. Again, this market, when I first found out about it, it was, you could buy something. I think it was like 150 grand. And this is obviously years and years ago. But I think to be able to buy in a capital city location under 600,000 is near. This is one of the last markets in the country that you're able to do that. So I think for that reason and that reason alone, it does make for good buying over the long term. It does have an improving tenant profile. That part of the city has historically been, the demographics not being great there, and the socioeconomic situation. But bit of gentrifying suburbs, gentrification taking place. Decent yield compared to other parts of Adelaide, and in my opinion, reasonable growth that you could expect over the long term. Probably not in the short term, but definitely over the long term. So where to focus over 800,000? There's only two locations, man. It's Brisbane. Where to focus under 800,000? It is Brisbane. So we've got Ipswich between the 650 and 750 range. One of the more affordable southeast Queensland sectors, rapid population growth. And yeah, it's in a capital city for, that 650 to 750. It is very rare. I don't think it's going to be around for too much longer. And I've seen a lot of movement there, in the last few years, and I think that will continue to sustain as we continue into the Olympics in a few years' time. Moreton Bay is probably approaching that 800K mark already. I've got a bunch of properties in Moreton Bay. Not many of them would sell for $800,000 anymore, which is insane because we were buying those when they were like 300 something thousand not many years ago. But Ipswich, Moreton Bay, I think if you want to get into a capital city under 800K, those are the two markets that I'd be focusing on. So that's I guess a bit of an overview of the market, what I think is happening on the broader level, plus some areas that I think you can look at, and yeah, obviously do your own sort of digging into those markets that I've mentioned. But if there was ever a time to stop watching and start doing, this is it. Like, we've got the early innings of a new cycle. We've got interest rates coming back down. We've got buyer interest that's growing. And there's a lot of undersupplied markets out there, which we are already and have been seeing for a while, a lot of upward pressure on price. So my thoughts on Melbourne, before we wrap this up, is I'm not fully sold on Melbourne as an investment play just yet. My main concern with Melbourne is it does have a lot of supply in terms of housing. And like I said, it just the simple basic economics, the simple basic economics of it is that in order to see that massive sort of price growth like we saw in Brisbane and we saw in Perth, you need to have that supply crunch, and I'm just not seeing it there. There will be select pockets, I think, that in Melbourne will do really well. In the short to medium term, but I'm just not convinced that now's the right time to get into doing it. So you've got to be laser focused on the quality pockets with tight rental supply, good demographics in the area, and that then you might do well over the long term. But for right now, for the prices that you're going to pay in other markets, I do think other markets, particularly for like Queensland, even regional Victoria, I think are better buying right now. Like Ballarat and Bendigo, than Melbourne. So, in short, my opinion, Melbourne is not quite go all in just yet. It will do well over the long term, but I'm just like, also the yields as well. The yields are crap down there, and that's not even factoring in land tax. So, like, yeah, just be careful is all I'm saying. Don't, like, there's a lot of I see like a lot of people would do property content like mine, and I can see them jumping on the bandwagon because they want to go and think that, Brisbane was the big market that popped off, and then it was Perth, and now they're going, okay, it's Melbourne. And don't get me wrong, Melbourne will grow, but I do not see it having this massive surge like Perth did. I don't know if any of you have been, I've been to Melbourne tons of times this year. Just go and have a look at the construction on the outer edges of that city. It's massive. None of that was happening in Perth, right? That was not happening at that scale in Brisbane, but it is in Melbourne. So this is what we've got to watch. Perth. Perth has momentum, all right? I've, in recent months, not had too good things to say about Perth. So I've got to eat my words again. There are markets that are surging. I wouldn't say surging. There are markets that are growing nice and consistently. There are markets that have some really good yields. So this is my word of warning out there to not just jump into Perth and go with any sort of set and forget type of investment. It's got to be like a tactical mission to go and find the right suburb. It's got to have all the fundamentals that are right, and just be aware. Perth has had a ton of growth, so when you're looking at numbers and data, a lot of that growth has already been baked into the numbers that you're going to see. So you're potentially buying someone else's gains. So just be careful about that. If I'm going to go into Perth, I'm doing it for a yield play if I needed to. Not really doing it for a growth play because my opinion, not my opinion, but historically Perth has surged for 1, 2, maybe 3 years, maybe even a bit more, and it just flatlines for like a decade, 15 years or whatever, and then it will surge again, which is what we've just seen. So I wouldn't be jumping into Perth for a growth play. For me, to be a yield play or potentially a development play, depending on where you are. So that's the property market update for July. Hopefully you got some value out of that. If you did, appreciate it if you could like the video, potentially subscribe if this property stuff is something that you like to see. We do this every single week. There's property updates, property insights from the Smash Property team. Thanks so much for tuning in and checking out the video. Until next time, thanks for watching. We'll catch you soon.